Hey everyone, welcome back to another video. In this video, I'm going to be talking about a stock that is definitely presenting a really good opportunity at the moment because of an up-and-coming catalyst, and that stock is Albertsons. And we can see over the last year, the company is down around almost 30% over the last year, while the rest of the market is down around 6%. So they are underperforming the market at the moment. And then over the 5-year chart, they haven't really been public that long, only since 2020, so they're up about 36% during that time period, while the S&P 500 is up almost 60%. And so we're basically just going to look into some of the recent news that's come out around Albertsons and then figure out the intrinsic value per share, and then also compare them to other companies we've looked at on this channel before. And so right here in this article, we can see that they're talking about the potential merger that is going to happen between Kroger and Albertsons, which are the first and second largest supermarket chains in the US. And one of the main concerns that this article points out is that these two companies are very large. They make up a large percentage of the retail market. They are only second to Walmart. And if they were to combine, they would account for around 15 to 16% of the retail market. And obviously this would lead to more profits for investors, but it could be concerning for farmers, as they point out right down here, because if the two retail giants combine, they would have increased leverage over farmers because farmers wouldn't really be able to sell their products to competing retailers for better prices. They would only be able to sell them to one very large retailer that would be able to set the price, and they would pretty much just be forced to sell to them at that price because they can't really sell it to that many other buyers that are as large as Kroger and Albertsons. And so that's probably like the main concern, and it's why a lot of people are a little bit opposed to this merger between Kroger and Albertsons. And so right here in their third quarter earnings reports, they went into the details about the merger agreement and the special dividend that's going alongside the merger agreement. In particular, they point out in this paragraph that on October 13th, 2022, the merger agreement was made between Kroger and Albertsons to acquire all of the outstanding shares of Albertsons for $34.10 per share. And for this special dividend, basically the company declared a special cash dividend of $6.85 per share for shareholders that were basically on record as of October 24th, 2022. And basically what that means is that if you owned shares of Albertsons on October 24th of 2022, you would be entitled to this dividend of $6.85 for each share that you owned. And basically, the special dividend was originally supposed to be paid to shareholders on November 7th, but the Attorney General for the state of Washington filed a motion to temporarily restrain the payment for the dividend. And so at the moment, the special dividend of around almost $4 billion is recorded as a special dividend payable on their balance sheet. And we can actually see that right here on their balance sheet that they reported for the third quarter of 2022. We can see that from the period of February 2022 to December 2022, total assets are up from $28 billion to around $30.2 billion. And we can see right here under their current liabilities, special dividend payable of $3.9 billion. We can see that their business is mainly financed by liabilities compared to equity. They only have $819 million worth of equity, which is down from around $3 billion from the previous period. And we can see that's mainly as a result of a decrease in retained earnings, and the decrease in retained earnings came from the fact that they issued the special dividend payable right from their retained earnings line item. And so now right here we can see this is their income statement year over year for the third quarter of 2021 compared to 2022. During that time period, total revenue is up from $16.7 billion to $18.1 billion, and net income is unfortunately down from $424 million to $375 million. And then lastly, right here in their cash flow statement, we can see they're comparing the 40 weeks ended December 2021 to December 2022. And we can see during that time period, operating cash flow is down from $2.7 billion to around $2 billion. And we can see they paid out dividends so far of around $190 million to their shareholders. So they are returning a little bit of value back to shareholders at the moment, but it's really nothing in comparison to the special dividend that will be paid out to shareholders of record once that gets cleared with the Federal Trade Commission. And so right here, we can see this discounted cash flow model trying to figure out the intrinsic value per share for Albertsons. Yahoo Finance basically believes that they're going to grow at around 8% compounded annually for the next 5 years. We can see they have free cash flow of around $2.5 billion for their most previous full year. And they have a net debt position of around $10 billion on their balance sheet and 535 million shares outstanding, which means their intrinsic value per share is estimated to be around $47 per share with a 50% margin of safety of 23, which means that at the moment, they are currently trading below a 50% margin of safety since they're trading at $21 per share. So if they're able to grow at this pretty conservative growth rate of around 4 to 8% for the next decade, then they're currently trading well below their intrinsic value per share. And obviously, if the merger with Kroger goes through, then the special dividend will be paid out and the merged new entity will probably end up being more profitable because of the fact that they have more leverage over farmers and over customers, and they'll have better control over prices. And so on the right-hand side here, I compared them to a few of their competitors, Costco, Target, Walmart, and Kroger, which they are anticipating a merger with. We can see that in comparison, they have a pretty high gross profit margin, pretty much neck and neck with Target and Walmart. In terms of net profit margin, they're not doing that great. They're on the lower end of the net profit margin spectrum, Target being the highest. Target also has the highest return on assets. Albertsons is around middling of the pack. In terms of PE ratio, Albertsons looks to be trading at the cheapest price relative to their earnings in comparison to the other retailers. And then in terms of dividend per share, they do pay out the smallest dividend per share, with Costco and Target tied for first place. And so in comparison, it looks like the best stock to buy based on profit margins and dividend would probably be Target. And in terms of PE ratio, it would actually be Albertsons. They seem to be trading at the cheapest price relative to their earnings. And so on the right-hand side here, I continued the trend over the last few videos of comparing them to the other videos or the other companies we've been talking about in the previous videos. We can see that in terms of share price compared to intrinsic value, so far, based on the last 4 videos, Albertsons is trading at the best price relative to intrinsic value per share. The other companies, Accenture, Adobe, and Nike, were all trading above intrinsic value per share, trading at 1.25 times intrinsic value, 1.37 times, and 2.65 times intrinsic value. Albertsons is the only company out of the 4 that is trading below intrinsic value. They're currently trading at 0.45 times their intrinsic value per share because it's $47 and they're trading at $21 per share. So not too shabby for Albertsons. In terms of growth rate, they have a growth rate of 8%, so they're on the lower end of the spectrum, but that's actually pretty impressive considering that their intrinsic value, that their share price is trading below intrinsic value per share, but they have one of the lower growth rates. When you increase growth rate, the intrinsic value per share for the company's stock actually gets higher. So the fact that they have a low growth rate and they are trading below intrinsic value per share means that they could be presenting an even stronger buying opportunity relative to the other companies on this list. In terms of profitability margins, Albertsons is at the bottom. Obviously, these are completely different industries, and so it's really not that fair to compare them like this. So we're just comparing them on a video-to-video basis. And then if we want to look at the profitability of the companies relative to their industry, we obviously saw that in the industry analysis I did right before this. But at a 2% net profit and a 26% gross profit, they are definitely not doing as well as, say, Adobe with nearly a 90% gross profit and a 27% net profit. And then lastly, in terms of stock performance over the last 5 years, Albertsons hasn't even really been public for 5 years, so it's kind of hard to make a direct comparison here. But that being said, with the information we have available to us, they're basically up 36% since going public in 2020. But they're not beating out Adobe's near 100% return over the last 5 years. So In terms of profitability and stock performance, Adobe is still holding our number one spot. But in terms of growth rate, Adobe is holding the number one spot. But in terms of intrinsic value, we can see Albertsons is trading at the best price in comparison to the companies we've talked about thus far. In terms of competitor analysis in their industry, looks like Target is doing the best in terms of profit margins and Albertsons is trading cheapest. And then in terms of intrinsic value, they are definitely trading well below their intrinsic value per share if they can maintain these growth rates of 4 to 8% over the next decade or so. So definitely, in my opinion, it looks like Albertsons presents a pretty interesting opportunity at the moment. I'm going to be keeping my eye on this stock. Let me know in the comment section down below what you guys think of this company. Is it a good buy right now? Let me know what you think. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.